On this show, we appreciate that when we talk about SMEs in Uganda, most of them are family-based businesses. We will not tire giving you tips on how you can make it as a family business in this space.
The world's economy today is run by large companies, most of which are family-based and have been in existence for over 100 years. Take, for instance, Ford, Toyota, Daimler-Benz, Samsung, and many more. In Uganda, there are quite a few, one of the notable ones being Madvani. But there is a setback in this kind of enterprise. According to PricewaterhouseCoopers, only 30% of family businesses progress to the next generation. Today, we give you tips for any family business that intends to continue 100 years from now.
If we want to grow this economy, we need to look at competitiveness of our own businesses, because we don't actually operate in isolation. Yeah, we need to, if we are looking at export markets, if we're looking at growing our own domestic market, we need to make sure that our own businesses are competitive. For you as businesses to actually consider about tax planning, yeah, many a time you find that tax evasion in itself increases the cost of doing business and probably makes you uncompetitive.
What does it take to build a business that will last longer than you and will be your legacy? I find probably it is not so much talent, because we emphasize a lot on talent and skilling them and training them, which is important. But what came out strong for me was resilience. The other factors that people don't see that keep you going, to make you really resilient and adaptable and able to be flexible, agility. Some of the things that are not probably emphasized enough in school when they are training, and you get only when you are in an environment.
You might have a succession plan in your mind or something that you've scribbled down, but is it robust? Is it documented? Is it discussed? Yeah. So making sure that that succession plan has been discussed is an area where family-owned businesses are actually struggling.
Now, an angel investor comes in, or a package, a PE comes in, they want approximately 20%. That's largely the hurdle rate in Uganda. They want to invest, most of them, minimum $5 or $10 million. Most of them are $10 million. That means in 5 years' time, they want to exit. Now, most businesses here, we build them because we want to pass on this business to your children, or you have a longer term view. Most private equity funds want 5 years to 8 years maximum, they want to exit. So if they're getting a return of 20%, in 5 years they've put in $10 million, they want $20 million. It becomes a tall order how they exit. So they say, either we're taking you to the market where you list. If you can list, then they make an exit, or we sell the business, because you sell the business, they'll cash in. But then you're out of the game because you couldn't pay the $20 million to them. So that's where the catch comes. And I warn many people that go in with your eyes wide open, get as much advice as possible.
These observations were made at a recent conference of CEOs in the country. So take up these observations as guidelines for your business and ensure you continuously have checks and balances.